Okay, let's dive right into this fascinating explainer by tackling those headlines you've probably seen popping up recently. You know the ones. The news about India seeking a massive $2.5 billion loan from the World Bank and the Asian Development Bank. It's totally normal that whenever numbers with a billion attached flash across the screen in the context of international borrowing, warning bells instantly go off in our heads.
Right off the bat, the absolute first thing we ask ourselves when we hear about massive foreign borrowing is, wait, are we facing some kind of economic crisis? Is the country literally running out of money? Honestly, it's a totally natural reaction, especially if you remember historical financial crunches. But as we unpack the actual data today, you're going to see a very different, highly strategic picture of how modern economic management actually works.
To get to the bottom of this, we're going to look at 5 key areas: decoding the loan, the massive subsidy shock, why not borrow domestically, funding growth, and finally, weighing the economic risks.
All right, let's kick things off with Section 1, decoding the $2.5 billion loan. First things first, we really need to clear up a massive misconception about the kind of money we're talking about here, because, well, not all international loans are created equal. There's a stark contrast. This is absolutely not an IMF rescue package for an economy in collapse, but rather a flexible credit facility aimed entirely at development. When a country goes to the IMF, it's usually an absolute last resort. Think of India's 1991 balance of payments crisis. That's an emergency bailout, but the World Bank and the Asian Development Bank, they operate completely differently. India is actually looking to tap into already existing pre-approved credit facilities. We aren't knocking on their door begging for survival cash, we're simply utilizing an available line of credit meant specifically to finance development and growth.
Which brings us perfectly to Section 2, the massive subsidy shock. So the crucial question is, if we aren't collapsing, why does the government suddenly need an extra $2.5 billion right now? What exactly changed? Well, we're essentially seeing a domino effect of global geopolitics hitting domestic wallets. Conflict in West Asia, particularly around key trade routes, severely disrupted global energy markets. And that drove up the price of natural gas. Now, why does that matter to India? Because natural gas is the primary raw material required to manufacture subsidized fertilizers like urea. The government fixes the price of urea for our farmers to protect them. So, if the global cost to actually make that fertilizer triples, the farmer still pays the exact same low price. The government simply absorbs that massive difference.
Then that subsidy burden didn't just increase a little bit, it completely skyrocketed. In the original budget estimate earlier in the year, the government set aside 1.7 lakh crore rupees for this. But because of those global shocks, the new projected reality is a staggering 3.4 lakh crore rupees. It essentially doubled. That is a colossal, unforeseen expense hitting the government's balance sheet all at once. But wait, there's more. Add to that the rising costs of transporting and procuring almost free food grains for massive welfare programs like the Public Distribution System and PMGKA. Plus, to shield citizens from high petrol and diesel prices, the government had previously cut excise duties on fuel, and that means less tax revenue coming in. When you combine doubled fertilizer costs, higher food logistics, and reduced fuel tax income, you can clearly see why the government's wallet is feeling incredibly tight right now.
Okay, moving right along to Section 3. Why not borrow domestically? This naturally leads to the most obvious question. If the government needs money to cover these subsidies, why not just raise taxes or borrow the money from Indian banks? Well, simply raising taxes is pretty much off the table. Not only is it politically difficult, but more importantly, it would completely undo recent corporate and personal tax cuts that were specifically designed to boost our economy. If you hike taxes right after lowering them to encourage business growth and consumer spending, you risk stalling the exact economic engine you're trying to rev up.
So if taxes are a bad idea, why not just borrow heavily from domestic Indian banks? Well, borrowing domestically at this scale leads to a really dangerous economic phenomenon called crowding out.
Think of it like this. Imagine a simplified model where there are literally only 100 rupees available in the entire domestic economy to be borrowed. If the government swoops in and takes 75 rupees to pay for its subsidies, only 25 rupees are left for private businesses. When private businesses can't get loans or when interest rates absolutely spike because cash is so incredibly scarce, they can't build new factories, they can't hire new people, and they can't invest in innovation. The government would essentially crowd out the private sector, and that stalls overall GDP growth.
That takes us to Section 4, funding growth, not weakness.
Understanding that crowding out effect helps explain why choosing external multilateral development banks is actually a highly strategic move for a growing economy. Tapping into institutions like the World Bank and the ADB provides incredibly cheap interest rates that domestic lenders simply cannot match. We're talking about long, highly flexible repayment windows, sometimes stretching across decades. Remember, the primary goal of these institutions is global development financing, not cutthroat corporate profit. By using these funds, the government secures ultra-cheap money, leaving the domestic bank funds available for private Indian businesses to borrow and grow.
And here's the absolute biggest takeaway. Taking this external loan prevents the government from having to slash its capital expenditure. Without this facility, long-term infrastructure assets, like building crucial new roads and bridges, would likely be cannibalized just to pay for short-term revenue expenditure shocks, like those ballooning fertilizer subsidies we talked about earlier. This loan protects India's long-term infrastructure building plans from being derailed by immediate, everyday operational costs.
And remember, taking a loan to ensure development continues is definitely not a sign of weakness. Think of giant, highly successful companies. They borrow billions to expand and fund new ventures even when they're super profitable. It's all about smart capital management. This is especially true considering the World Bank itself recently declared India the fastest-growing major economy, clocking in at around 7.6% growth. A truly weak economy just doesn't grow at 7.6% while managing complex fiscal consolidations.
Finally, let's wrap up with Section 5, weighing the economic risks. Because look, while this solves some massive immediate problems, no financial decision is totally without a downside, right? So we need to take a completely impartial look at the real risks here. While $2.5 billion is highly manageable for an economy of this size right now, this borrowing absolutely adds to our overall external debt. The most significant risk here is currency depreciation. We borrow and must repay in US dollars. If the Indian rupee weakens significantly against the dollar over the next few years, paying back that exact same loan will mathematically cost the government much more in rupee terms. Plus, there's the risk of future dependence. Relying too heavily on external safety nets for internal subsidy burdens can become a pretty dangerous habit if it's not monitored carefully.
So I want to leave you with this provocative thought to ponder today. As our economy continues its rapid growth trajectory, how exactly do we strike the perfect balance? How do we relentlessly fund our future infrastructure and protect our vulnerable populations from global shocks while simultaneously ensuring we don't become trapped by the creeping accumulation of external, dollar-denominated debt? It is the ultimate tightrope walk of modern economics. Thanks for joining me on this explainer. Keep asking the big questions, and I'll catch you next time.